There's a lot of gurus that have stepped out and just said, wow, market is crashing, right? Buy at the dip, right?
For the last few years, every time there is a market downturn, it recovered very quickly. So you buy the dips, wow, you're very happy about it.
Volatile.
Yeah, so you're very happy about
Yeah.
it. Even for the GFC, I think it took about 6 months, then the market started. I remember it was April of 2009, the market started
rallying.
And because of this, people think that, okay, stay invested, buy, it should be fine. But what if a 1930 happened?
Yeah.
Right?
15 years.
Yeah, and even if I don't stretch it to 15 years, 5 years, just say 5 years, right? China, 3 years, people already cannot take it anymore.
So right now, one concern have come out among the investment community is the US dollar. The US dollar has dropped a lot. And right now, I think we're trading at 130 versus the Singapore dollar. What's the view of this US dollar? And more importantly, also the appeal of US assets. Okay, be it the US treasuries, be it US stocks, whatever. You know, if everything falls, you know, should we run for our life and things like that?
I think that's definitely the main thing that's on a lot of investors' minds right now. And I think exactly you can see from the fact that the US dollar is so weak. So you mentioned about 130 to the Sing, right? So that's about 4.6% year-to-date fall. If you're going to look at it against the yen, against the franc, against euro, it's actually fallen by 10%.
Wow.
That means if you are euro, you just sit in cash, you can buy US stuff now, or it's 10% cheaper. So you know, it's a huge move in the currency actually. And it's and it's a surprising one, because typically when stock market falls, investors will rush to buy safe haven assets, right? And previously, US treasuries, US dollar would be considered that, and so investors would buy. So you see treasury yields fall, you would see US dollar go up. And then that's not really been happening this time around, because
the opposite is happening.
Yeah, the opposite is happening, which is why everybody is obviously wondering what's going on. I mean, it's hard to really say for certain, but I mean, obviously, given that the US administration has been very unpredictable in all the policy, like Chris mentioned, and all sorts of sudden changes, it's probably likely that investors, maybe foreign investors, maybe certain investors all over, are just sort of ascribing a higher risk to US assets, and so they are reducing their exposure if they think it makes sense. And that's why you see sort of the US dollar falling, you see the US yields going up during this time. So I mean, to answer the other part of your question, should we, get out and sell everything? I don't think so. I don't think that's sort of the right reaction, especially in the short term. I think the US is still a very large part of the global economy. I mean, US companies are still some of the most strongest businesses in the world. They create a lot of goods and services that consumers want. So there's definitely a lot of benefits. But of course, it's probably sensible to make sure that you right size your allocation. I mean, you probably shouldn't be all in, right? You should have a very diversified portfolio to maintain.
So should we then pair now?
I mean, at Providend, we never really change, because we're already in a diversified portfolio,
that's
right?
That's a good point.
We keep a very diversified holding, so we have not really needed to adjust our portfolios too much. Of course, the last 2 years when the S&P was doing 20%, then we are diversified, so our portfolio never do 20%. We only do 15-16%. Our clients ask us, why are we not?
So now they're thanking you already, right?
Well, now at least they are little. They understand why when we tell them in the last 2 years that we stay diversified, we try and make sure that we maintain our exposure to other markets, because even the last couple of years we kept exposure to emerging markets and China, right? A lot of people were asking why are we still keeping the exposure there, but this year has become an outperformer. So I guess now maybe at least our clients can see the benefit of diversification.
I think going back to one question before, right? I mean, like you asked what lessons do we learn, right? In fact, one of the lessons is that you really shouldn't just be concentrated on just one country index, because if that particular country index, like the S&P 500, tank for 15 years, then if you are not investing in any other things, then you are probably going to be a lot worse off, right? And like what Chai-Sen said, if you diversify, you are probably going to do better. But just as a side, just now when you were talking about, these things about the US dollar weakening, I just suddenly had a realization. I'm going to US in 2 weeks' time. Wow, perfect timing, because the US dollar has weakened, right? Wow, very good, I can change more, right? And then the prices not really impacted yet. Wow, best time.
Yeah.
Because now I can buy more things when prices have not gone up.
All go US for holiday now.
I mean, the prices are not felt yet, right? So I should go and order a lot of things from Amazon, and then send it to my hotel. I should go to the Lululemon there and buy plenty of Lulu.
Your favorite. Yes.
Perfect time to go US.
Yeah.
As long as I'm not stopped at the security at the border.
I was about to say that they will be mistaken you as someone from China and then get detained for 10 hours.
Yeah. Pretty hard. Yeah. I can come back after 2 weeks.
So a lot of my followers are now saying, time to siam US and now fall back to Singapore. And Singapore, everybody really buy 3 counters: OCBC, DBS, and UOB. Right? Forget about everything else. What's your view on Singapore equities, especially banking stocks and things like that? Is this something you will bet on?
Well, investors are definitely very excited. The banking stocks, I think they've recovered a lot of the losses. I just looked at it today, yesterday, the stocks are up quite a bit since the fall. I think overall, Singapore market is doing very well this year. If you look at STI, it's almost, I think, flat for the year. But that means in US dollar terms, outperforming by 4.6%. Right? So it's I think you can definitely see some rotation back into Singapore assets. I mean, of course, our banks are well run. They are safe. They have strong credit quality, but I think we should, as Chris mentioned earlier, the one advice we would just give all our clients, even the viewers, is probably make sure you are diversified, because while definitely right now Singapore looks a bit more like a safe haven, but of course Singapore is also not immune to all the things that are happening in the world. Our economy is very open, so very exposed to if the tariffs are not removed, if the tariffs stay and trade flows start to reduce, we will definitely affect Singapore. And banks are a big barometer of economic growth, right? Because, for example, trade finance, if there's less trade, then the banks will make less trade finance loans. That affects their earnings. If there's a slower economic growth, less people might buy houses, less housing loans. There might also be less interest in wealth management if the markets don't do so well. So, there are definitely headwinds. So, I would say, while the banks are good companies, just should keep in mind the risk. Also keep in mind valuations. I think price book on DBS is about 1.7 times, OCBC, UOB is 1.2 times. So, they're also trading quite a bit above the price book. So, of course, right now, markets are obviously pricing them that way because they are good companies. But of course,
flight to safety.
Sure. But investors need to be aware of the kind of valuations and what's priced into the stock when they're buying.
Are you all personally investing in any Singapore stocks?
For me, no.
I have a bunch of Singapore stocks that I have from mostly before I joined Providend.
I see.
Yeah, so I haven't touched it
invest
for a
in
long time. So
Singapore stocks. We all invest in Singapore stocks in some form through the exposure of our portfolios. But for me specifically, in owning individual stocks, I've got the stock that you used to work.
Singtel.
Until now. I didn't sell.
How many years is that already, man?
I don't know, man.
30 years or something like that. You really so loyal.
No, not that I'm loyal. I just didn't bother to sell them.
Yeah.
Other than that, no, I don't own individual stocks.
Really? Okay, yeah. But it's something that does it warrant the current environment? Does it warrant you right now to make certain shift for your client's portfolio?
I mean, we have not done that.
Okay.
I mean, at Providend, we don't believe in short-term, what we call tactical asset allocation, right? Moving the portfolios from one asset class to another asset class, moving from equities to bonds, moving from equities to cash, or rotating the regions. This is not what we do. Of course, if you can do it well and you do it right and you can find the perfect time to do it, you'll be very successful.
Yeah.
Your portfolio returns will be much
I
more
lose
higher
that.
than market. Yeah, if you can do that perfect timing, then you're very successful. But of course, if you on the other extreme, right, if you do it wrongly, then you are going to do very badly. You're probably going to do a lot worse than what the markets can give you. So for us, we don't believe in that. For us, we believe in deciding on the long-term strategic asset allocation, and then we don't tweak it a lot. It's not that we don't look at it. We still look at it. We may tweak it if there's something that we believe may affect the long-term returns of the portfolio. But short-term, we don't do. And also because I think from evidence it's been shown that making all these little tweaks here and there, short-term moving, has not shown a lot of success, right? A lot of professional fund managers, they may say that they can do it, but evidence from what we can see from the report cards is that most cannot do it successfully. Even for those that can do it successfully, they cannot do it consistently.
Can you all do it?
No, and that's why we don't do
Even
it.
you all cannot. You are like the guru of the country in here.
Well, yeah. Maybe Chaisen is the guru. He used to work for a private equity
Are
fund.
you
He used to
able to
work for a
stop
hedge
it
fund.
and then so chun buy at the bottom, sell and go up, don't know what. Because I kid you not, in my 165 community, they swear by it, there are like a few gurus say, I'm able to buy this stock right chun at this point, then sell at this time, and then I make gazillion dollars.
Ask him. He used to work for one of the biggest hedge fund in the world. So
really?
Can you do it?
Can you do it?
And if I can do it, then I would be on the beach in somewhere now enjoying my life. I mean, I definitely wouldn't be working if I could do it. Right? I would just trade, and if I can do it that well, I would.
So just be very clear, even experts like them, guru level, okay, stock picking is really stretching it now.
Yeah, I mean, there's another reason why we don't do it.
Sure.
Right. I mean, the reason is because the clients, the kind of clients that come to us, right, we are really helping them to achieve their non-negotiable life goals. It's non-negotiable. They have to achieve some of these goals, right? Some of these life goals or life events like retirement, like sending their kids to school, like living out a purpose in their life is non-negotiable.
Non-negotiable life goals. Wow.
So if their goals are non-negotiable, I'm not going to use an approach that doesn't give them the higher probability of success. And it has been shown, like I said, trying to guess where the markets are going, moving in and out, stock picking. Well, some people can do it successfully. We're not saying you can't do it successfully. Some people can, right? We don't think we can. And it's not an approach that gives the highest probability of success. And because these life goals are non-negotiable, we need to use an approach that gives them the highest probability of success. And making tactical shifts, picking stocks, moving in and out, is just not that approach. So we'd rather not we'd rather not use that approach.
That's why Providend is such a great company. You actually, serve these clients to help them achieve this kind of aspiration. I thought, it is something that is very noble, and clearly you are growing from strength to strength. It's a great company. My only bugbear is that small timers like me.
You need me to
No.
I know. You are telling me to repeat what I say many times.
You love to say that.
I know you're just triggering me to say is you have the network, it's just you refuse to put everything with us.
So you always crack some of these jokes. We always like pull each other, but he's a great guy. Take note. What I'm trying to say is guru level like them, even them will find very difficult to stop pick, and I think that's a great lesson for all of us.
Yeah. But to be fair, right, Lu, there are people who can do it.
Yeah, we're not saying that
Rare.
people cannot.
Yes, there are people. It's just that we choose not to do it because that's not our mandate.
Okay.
Right? I mean, the mandate that clients give to us is no, we don't need you to give us the highest returns. We just need to make sure that when we need the money to do these non-negotiable things, we need to have the money. So if that's the mandate, then we got to use an approach that gives them that probability of success.
Yeah.
Right. So we are not saying nobody can get it.
Yeah.
Right. It's just we are not the guys, and our mandate is different. Our mandate is just to make sure that you need to retire, you can retire. You need to send your kids to overseas university, you got the money. You need to go and take care of your parents, you have the money. That's the mandate, and so we got to find a surer way to do it.
Oh, that's a very noble. So how with all your clients right now and your there's so many clients right now, you know, your AUM is just growing from strength to strength, which also means a lot of clients are now entrusting their life goals and those kind of goals related savings with you. By this kind of volatility, how do you ensure that goal will still be reached? What are you all doing to handle this period of volatility? It's quite scary, you know.
Yeah. Well, firstly, if we only handle volatility when it happens a bit too late, right? I mean, when you go up a plane, you don't get the cabin crew to start telling you the drills when you go through a turbulence. You go through a turbulence, right? When the plane is about to crash, and then your captain start telling you what to do, it's a bit too late. I think you have to be prepared beforehand, and I think for us, over the years, we have been preparing our clients for volatility, especially the last 2 years, because the last 2 years, and when I say last 2 years, meaning 2023, 2024, I mean the returns have been fantastic. And markets have been giving like 21% return, 2023, 2024. Our portfolios have not done too badly as well. And so the last few years we have been educating a lot on the possibility of a downturn, a market crashing, volatility, because the best time to do that is when times are good, right? So I think when this happened, it was not a surprise for our clients, right? But it doesn't mean we didn't do anything. In fact, the last few weeks, the last 1.5 months probably, we have been very busy. We have this drill that we have been practicing over the past few years. It's like mobilization.
Really?
Yes, a mobilization, open mob, close mob.
Yeah.
Right? And we have been practicing, the advisory team, the investment team, and the rest of the people who are involved. We've been practicing this drill. What if you get a market correction? What if you get a bear market? There are certain triggers that Chison will use, that when the market crash, he will activate this whole process. And the different parts of the companies are involved, not just him, the advisory team, the brand team, the investment ops team. You know, everybody gets involved because we need, we do a series of activities to calm the clients, right? Involves doing events. In fact, last week we just had a webinar to calm the clients, to talk to the clients. We have our client advisors calling different clients. They've categorized different clients, which are the clients they should call first. We send quite a number of email communications out to our clients, you know, all with one objective, and that is to make sure that clients don't jump out at the wrong time. Yeah. The good news is, because of all the previous education that we have done, a lot of clients, they told us that they are not panicking. But like I said, really, it's just really the start of this whole thing. We don't know how it's going to be if this thing persists on for the next few years. Yeah, so the things that we do is not busily shifting clients' portfolio, making changes to client portfolio, moving to cash. That's not what we do, because like I said, the strategy, the investment strategy that we put forward is meant for the long term.
Yeah, just to jump in there, I mean, while yes, we don't, you know, when volatility happens, we are not, oh, we got to change this stock, or we got to cut your allocation.
Swing to this and
swing to that, or we have got to, you know, okay, now we think this new stock will perform, we're going to buy this one. I think what we do is, even like Chris mentioned, even before you get on the plane, right, you have to do all the safety checks. So for our portfolio, even before, I mean, at the point where we are creating our portfolios and we are looking at how we invest, we are thinking through a lot of things. So first of all, I've mentioned, of course, diversification is one of the things that we focus on. So, you know, things we add sort of new funds to the overall portfolio. Say they give you more diversification. Like previously, some of our bond funds, they were not able to hold Chinese government bonds. But then we recently added in a fund that can hold Chinese government bonds, and that has helped our clients weather this storm because Chinese government bonds have been very stable. Right, well, other
More stable than
US Treasury fall, but then the Chinese government bond have been stable, right? So that has helped our portfolio. I mean, we think through diversification also, not just country but also sector. So I mean, even to say you invest in US, not sector, sorry, factors. So even invest in US stocks, value stocks in the US have generally outperformed by quite a large margin versus growth stocks in the US this year. So last I checked, it's about 10%. I've changed a bit now, but still a very big margin. So factor allocations also help to reduce the impact of volatility. So all these components of the portfolio are all designed to help the clients weather this kind of storm. Also designed to help capture the kind of performance that the clients need to achieve their life goals. So we are, yes, we are not experts at picking stocks and thinking about which is the best at this time or at that time and making these tactical changes, but we come to it more from a strategic and long-term kind of asset allocation viewpoint.
So like Chai-Sen said, right, so actually a lot of the investment work is also done before any volatility or crisis. I mean, we frequently meet with the managers. I mean, you know that we use a lot of dimensional funds, dimensional fund advisors funds, right? And I mean, we meet them every quarter. So a lot of the work is done even before a crisis happens. And of course, when a crisis happens, where necessary, Chai-Sen will also reach out to the fund managers to make sure that everything is okay. They are still managing the way they are supposed to manage. So we don't tweak the portfolios because of a crisis. And like I said, once we kickstart the activities, because we know that the portfolios are okay, they are all well structured. In the long term, it should deliver the expected returns that we need to give to our clients. We are more concerned about clients bailing out at the wrong time, right? So this whole series of activities that we do is just to make sure that clients, they are okay. In fact, some clients during this period, they put in some money. We are also concerned if you are too excited about putting in more money, because we need to tell them that, look, when you put in this money, don't expect a V-shaped recovery and you can take your money out in the next 6 months, 12 months, right? Just in case you put in this money and then the markets, they don't come back until 5 years, 6 years, you're okay. So we do a lot of these kind of things, and that's why different people are involved. So yes, we are very busy over the last 6 weeks or so, but I would say it's good busy. We are busy doing the right things. We are not busy scrambling, trying to prevent clients from redeeming and making changes to the that's not something that we are busy with.
I see. So you actually mentioned a very important point right now. There's a lot of gurus that have stepped out and just said, wow, market is crashing, right? Buy at the dip, right? Don't panic, don't bail out right now, market crash, quickly buy, right? Stupid Mr. Lu, right? Market has went down by 10% already. They missed out the stupid bull run, that kind of thing, right? So I get this almost every day, by the way. What's your view in times like this? Crash buying, buy on the dips and things like that. Hold on forever. There's so many school of thought now.
I think on the positive side, it's really encouraging to see that. I don't know where Chai-Sen remember in 2008, there was no one coming out to talk about stay invested, and all that. Everybody was just panicking, sell, right? So I think the investment literacy of Singaporeans have gone up.
That's wonderful.
Right? So people are talking about don't panic, stay invested. I think that's really good. And it comes from a good place. It's with a good intention. People say don't panic. In fact, if you have got some dry powder, buy the dips and all that. It came from the right place. So it's really good. My only concern is that sometimes we do it without providing context. Like we have shared earlier, right? I mean, because of recency bias over the last few years, every time there is a market downturn, it recovered very quickly. So you buy the dips, wow, you're very happy about it.
爆탄.
Yeah, so you're very happy about it. Even for the GFC, I think it took about 6 months, then the market started. I remember it was April of 2009, the market started
rallying
again,
quite
right?
a big rally.
Then after it persists on for a good decade. And because of this, people think that, okay, stay invested, buy, it should be fine. But what if a 1930 happened?
Yeah.
Right?
15 years.
Yeah, and even if I don't stretch it to 15 years, 5 years, just say 5 years, right? China, 3 years, people already cannot take it anymore. And then people start selling. Then I think we are doing them more harm than good. So I think we need to be careful, right? When we tell people stay invested, keep investing, buy the dips, it must be done with proper education to say this must be money that you really don't need. Be prepared to be in really for a long time, right? So that's one thing. We say the same thing, honestly. We say the same thing. We are sending out the messages to our clients to stay invested. And if you have got some spare cash, you want to put in some, you can put in some. But you see, we do it on the basis that we know our clients very well. Almost every client, I would say 99% of our clients have a wealth plan done by us. So we know their need to take risks. We know their ability to be able to take the volatility. We know their willingness. It is like, and I just written a BT article I sent you, right, as well, right? It's like...
It's a great article.
Thank you.
I'll put the link in the YouTube description. Everybody must read that.
Yeah, it's like today I'm your trainer and I train you and you are running, right? And you're panting like mad, you're going to die already, right? Actually, you have a heart problem. You are actually experiencing breathlessness already. But I don't know your health situation. And I just do what a good SAF officer would do, right? Press on, guys, press on, don't give up, try your best, you can make it, right? You're going to die. I'm doing you a great disfavor by pushing you. But if I know your health situation, I know when to pull back. I know when to push you, right? So we can do that. We are telling our clients to stay because we know their financial situation, right? That's why we are telling them. But to just broad stroke and tell everybody just stay invested for the long term, just put any spare cash inside, can be a bit dangerous.
Disastrous.
I'll just say one last thing. So I talk about we know our clients' ability to take risks. We know their need to take risks. We have their wealth plan. We ask them to stay invested. They know they have to stay invested. Then why do those series of activities to still calm them? If they know, right? And it's because we also realize through all these years of experience that the head and the heart cannot connect.
The head and heart cannot connect.
During planning stage, you can show all the numbers. They know they need to stay invested. They know the facts that the market will go up in the long run. They know that they have the ability to stay invested. Their financial health is good. Their debt very low. They got emergency fund. They got a job. They know all these things. Their head knows, right? But the heart cannot connect, right? When the markets are very volatile, when they read the headlines. Today I just read the BT one of the page, right, about the possibility of Powell being forced to leave, and then the commentator said that if that happens, I think you cannot trust buying US assets anymore. So all these headlines are very scary, right? So all these whole series of activities that we've been busily doing for the last 6 weeks, and I've been so busy I have no time to even speak to you, to anyone in the public. I didn't even post anything at all. The whole purpose of that is to connect the head with the heart, because the emotions get stirred.
I see. Well, that's so important. So in investment, the heart needs to be connected with the head.
Yes, and most times, well, like it or not, do you make decision with your heart or your head?
A lot of times the heart.
If we are honest about it, most of us make heart decisions.
Emotional decision.
Right? The head understand, but the heart cannot. You don't need to run, but your heart tells you, tomorrow then run. So yeah.
So as individuals right now, investors, what should we do right now? As you're a company, you are doing the right thing, but you are one big company. You have all the experts. So individual investor, not just from an individual investor, but also from employee. What should we do right now in times of this kind of volatility?